Well, good afternoon, everybody. Welcome to the December 8th mid-afternoon bull session. My name is Mark Robertson. I'm founding and managing partner of Manifest Investing. I'm joined here by my dear colleague, Ken Kavula, from a few miles to the north where he may be getting a bit of snow. How are things up there, Ken?
It's really dark outside, but at this point, no snow.
Well, I'd like you to hold that snow off until I get my in-laws moved from point A to point B. If we
Okay.
could possibly arrange that. And Ken and I are also joined here by Kim Butcher, who I don't think is battling snow in Florida.
No, just 60-degree weather, which I think is blissful and Mom hates.
So it's a chilly 60?
Yeah.
Wow. To be chilled at 60. Good stuff. All right. So welcome, everybody. Again, our intent is to basically grab or latch onto a topic or two and explore them, perhaps answer a question or two, although we'll do a little less of that this week. We are going to share a couple more of our favorite books, but the main theme this week is going to be the challenge of recessions with respect to our analysis activities. And what it means when we have one of these things called a chasm. Ken and I have done some work on this in the past. We're going to be refreshing, and I think I'll leave it up to Ken to make the final judgment on this, but bolstering the way that we look at some of this type of stuff. All right. So let's go ahead and get underway, get the official stuff out of the way. No investment recommendation is intended. This is all about education. It's about illustrating and demonstrating the principles, philosophies, methods, analysis techniques of the modern investment club movement, again, as championed by the National Association of Investors, now known as Better Investing, or us at Manifest Investing, our interpretation of the same. The views and opinions that you hear are ours and our own, and we will try to disclose if we talk about a company that we happen to own in our own personal portfolios. But please, please, please do your own homework and make your own decisions. That's what this is all about. We do a monthly roundtable. I think everybody here on the roster is a pretty familiar name, and you know this, but the last Tuesday of every month, generally, we do a thing called the roundtable. And if you would like to be added to that program, which is a simple program, it's a webcast where we share ideas, specifically, usually 4 or 5 of our current stock ideas for further study at the time. If you'd like to be reminded about that, please send an email to nkavula1@comcast.net. You can also go to the betterinvesting.org website, drill into the Mid-Michigan chapter, and you can actually do a self-service subscription to that mailing list right there on their chapter webpage. If you have any questions or follow-ups to the topics that we kick around in these sessions, please send an email to markr@manifestinvesting.com. If you want copies of the slides, although copies of the slides are available immediately following the program at Manifest Investing. But please, love to hear your thoughts. I want to just take a moment and issue a heartfelt thank you and a huge dose of gratitude for the dozens of people that have done that over the last couple of months. It's really been quite gratifying to hear your questions and suggestions, and I know, Ken, you see some of that same type of flow, and we are most grateful.
It's always nice to get mail, Mark, especially mail that says thank you and things like that. I can really gauge how involved my audience has gotten in one of my presentations by the amount of mail I get. I'm surprised, but pleased when I do something, whether it's here or on Ticker Talk or on the roundtable, and I get 15 or 20 or 25 emails about the topic. That means that there's probably 10 times as many people that were actually interested in it. That's very heartening for a volunteer to get that kind of feedback.
And we are actually all volunteers in the stuff that we do at heart, even though Manifest Investing is a subscription site. I think you guys all know that we spend a fair amount of time supporting the efforts of the national education movement on behalf of really successful investing within the community. All right, here's our bullpen. It's not all inclusive. There's actually a couple that I'll have to add to this after the session as I do a little bit of catch up. But again, the thinking is just show up here on Tuesdays and kick some of this stuff around. This week, I should say, we are going to go with Chasm jumping with Evil Knievel. And Ken, am I allowed to use Evil Knievel? Is that too?
Oh, absolutely. As long as we don't have to wear Evil Knievel costumes, we're all set, Mark. You know that.
Well, you know, I don't think we can rule that out for the future. So
Yeah, we can.
We'll see. We'll see.
Yes, we can, Mark.
I think I could do without the crash and burning part too, but we basically want to pay a little bit of homage to Mr. Knievel and his exploits from I guess a few decades ago now, going back. All right, here's kind of the one slide that I wanted to kick around for a few minutes. It actually comes to us courtesy of J.P. Morgan, and I will spare myself and all of you what they may have been trying to say with the slide, other than they're talking about returns by asset class over a 20-year period, and picking on the average investor. Again, that's none of you that are here, but the average investor, as perhaps characterized by entities like Dalbar, where they try to track and figure out how overactive, performance chasing, hot stock tip. I hesitate to pick on the current people at Robinhood, but there's been a lot of that in the press too. How does the average investor do? And a lot of times they're overactive and really not committed to what they're doing, and they do end up on this right-hand side. One of the things that as I sometimes have one toe in the investment advisory world, and one of the things that has always kind of bothered me a little bit is how locked in they are on this thing called asset classes. And they tend to think of all stocks as this thing in the middle. And Ken and I were talking a little bit before we got started. It's kind of maddening when you hear, I don't know if maddening is the right word, frustrating, or in some cases, I would almost tiptoe over to humorous to hear them talking about stocks as this big monolithic, homogenous thing. Has that been your experience, Ken?
Well, yeah, absolutely, Mark. I think I told you before we started that I've gotten more cold calls from my broker about my asset allocation, and I'm mostly in stocks. I have very small holdings in bonds or in anything else. But then again, that's only one brokerage account as well. So he's always worried when he calls that I'm leaning way too heavily into stocks and stocks in a lot of cases that he doesn't know the names of, that he's not aware of what's going on with those stocks. So, we don't talk too much about it, and I just indicate that I'm very comfortable with what I'm doing, and that it seems to work for me. What I don't like, however, is the fact that I think that almost any of these brokers that are calling me, at least, would love for me just to abandon my strategies and move to something that they consider appropriate for an old guy. And that means loading up on a lot of bonds and moving to index funds and a lot of things that I think would lower my returns significantly. So I guess I'm waving a flag out there and saying, be very aware of these cold calls, even if they're coming from your own broker. And Mark's absolutely right. They'd love to have that money channeled into a plain vanilla index fund along with a sizable holding in bonds if you've reached 60 or 65 or something along those lines.
Yeah.
So
we certainly don't want to give the impression that index funds are bad.
Absolutely not, right?
For some investors, that is the way to go. I do think that we have, again, 8 decades of experience with you can do better, and it really doesn't take a whole lot to get there. And No, the main thing that I want to point out about this slide, again, asset classes from real estate. By the way, this one is really, really, really sensitive to which starting year you pick and which ending year you pick. If you tried to draw this bar, after 2006, that would have been a really tough time. So again, a lot of times these bars are going to float around pretty dramatically by which end point and which starting point you pick. That's what I mean by this terminus anxiety. A financial professional trying to sell you something with a cringe. They can basically make any case that they want depending on the period shown. So you got to be at least aware of that and knowledgeable about that.
We're going to be talking about these chasms going forward, Mark, and I'm just going to urge all the folks with us today, and there's 40 or 50 of them, to internalize the frequency of movement of the analyst community. They're the ones that create these chasms, and these chasms just kind of open up like a sinkhole and sometimes close right back up again as well. So we need to be aware that kind of behavior exists, and I think that's one of the things we're trying to point out.
Yeah, and of course the other one, and I think this slide has been improved dramatically by me, with just the awareness that simply investing regularly into the value line arithmetic average. You want to talk about investing in an index, let's invest it in all of the above index that includes medium and smaller companies. And doing that gives you this 9.2%, which is almost off the chart this way, right? So again, quite the advantage to the S&P Vanilla 500. And then you take it a step further and say, why don't we just pick some excellent companies when they're on sale and hold them for as long as it makes sense to do so? And you get this one, the 10 cup over that 20-year period. And by the way, this is after one of the worst months in the history of 10 cup. If you guys think back to December 2018, do you remember how bad the stock market tanked that month? And 10 cup was actually pretty dented by that December 2018. Notice that even after the carnage and damage was done, we're still looking at 14%. So that is way off the left-hand side of this chart. And again, we believe that investing in all of the above, especially when you stick to excellent companies on sale, you can do this. And again, I think it drives most of the professional advisors crazy. The other thing that I would point out, we don't need to spend a lot of time talking about it, with interest rates as they are, the 60-40 mix between stocks and bonds and all that stuff is really having a rough go right now. It's really hard. We talked about it a few weeks ago, how low the rates of return are on some of the interest-bearing, quote-unquote, investments. I call them parking spots.
Well, I also think the generations beginning to live into their late 70s, mid 80s, late 80s is playing havoc with this 60-40, 40-60 kind of investing as well, Mark.
Absolutely. All right. Enough from this particular soapbox. Again, I think we know that sleeping at night with a collection of really excellent companies that you bought at the right time and experience the good side of the rule of 5, the 4 out of 5 that do pretty well, and just keep doing that. Good stuff. All right. A few months ago, Ken and I presented a program on chasms or chasms. I'm not sure what the correct word is, probably both, but chasm cartography. If you want more on that, you can actually go back on the YouTube site and revisit that program. But we want to kind of drill into with a little more detail to some of the notions we kicked around that evening. And here's our tribute to Evel Knievel. Do you remember when he tried to jump, or he did jump the Grand Canyon? I can remember the gala event myself, and I would have been much younger then, Ken.
We all would have been.
There's hardly a time in history that we can pick when we wouldn't have been much younger, Mark.
And as I recall, he did land. He might have skidded sideways to a stop, but he did make it. And it's just an example of one of the truly incredible things he did as a stunt artist. All right, so here's what we want to talk about. And this is from a little over a year ago. You'll recognize this as a kind of a map for the last 20 years or so of the value line arithmetic minus the banks and insurance companies. That's what it means by X financials. So we're looking at the profitability as measured by percent net margin. It's a median, pretty close to an average, but it's a median of the industrial type companies in the value line investment survey. So we publish this graph fairly often, and the things we notice is, and it's kind of the theme for what we want to talk about, back in 2008, 2009, during this time frame, you probably remember the days when your stock selection guides and your stock studies were more challenging and simply were wrecked. And the reason they were wrecked was because of this gray shaded area known as a recession and the condition that you see there. And a little over a year ago, we were kind of sailing along pretty well. And I want you to notice that the estimates towards the end of 2019 for the next few months basically were projecting a little over 8%. They were looking for 9% and then continuing to increase going forward. So basically tracking on that blue line and setting all-time records, etc. Well, what actually happened? You fast forward just a few months and things began deteriorating. You see the big drop, the amount of the drop is shown by the yellow bar over the next approximately 6 months. And all of a sudden, the forward-looking forecast began dropping off. And again, I just wanted to sequence through a few of these to show you how the deterioration was happening. Remember, this number was 8, this number was 9, this number was 10, and now they're basically down where you see here. And as the days went by, it didn't improve, continuing to sink. The long-term forecasts sinking and becoming much more pessimistic. Here's the end of March. You can see that the profitability levels for 19 and 20 at that point in time were beginning to approach what actually happened during we need to find a new word for Great Recession because there was nothing great about it. That recession from 11 or 12 years ago. And then again, just sequencing down, April as spring came, the numbers continued to weaken. And then, Ken, do you remember this day? I can remember we did a presentation. Look at this dude down here. I mean, the analysts were, that's, boy, you talk about throwing in the towel.
Well, not only that, Mark, check the blue line out. That was the first time in my recollection that the long-term profitability line had moved negative, and it was I don't know if scary is the right word, but it was certainly a time to make you stand up and pay attention real closely as to what's going on.
Yeah, so I mean, I don't think, obviously it did not persist and didn't continue that way. We'll see that in a second. But
Mark, we're getting a comment from a number of people. Why isn't there gray shading around 2020? And I suppose that when this recession is officially called to an end, we will add gray shading to the portion that's an official recession. But you could imagine gray shading underneath at least the year 2020 for some of it if you want to.
You mean like that?
Just like that one, uh-huh.
we have a sharp audience. It actually was back in that time frame, late summer, that they finally relented and said, we're in a recession. I mean, I don't think you need a whole lot of math to figure out that something's wrong here. So at that point, close to that point in time, and we're still in it, by the way, this gray area is progressing to the right, still in it. But notice that just a few months later, early September, this had to improve fairly dramatically compared to where it was just a few months ago. And there just was a whole lot of more positive signs beginning to erupt back in early autumn of 2020. But the chasm...
Mark, back up one slide if you would, Mark. When we're on this slide in June, we're probably at the tail end of adjusting for the 2019 earnings. So that 6 and a smidge growth for the 2019 earnings, that one's probably adjusted very close to the final number. And here they've adjusted it up to maybe 7, maybe a little bit more than 7. So that one will now kind of stay steady as we move forward. So that, like I said, that chasm is opening up sometimes and then just as readily closing as the numbers come in, as reality sets forward. Sometimes they go in the opposite direction, but there's that pendulum idea with the analysts moving way past where that probably they should have on the negative side, but also we've been in times when they've moved way past on the positive side. So we just have to get used to that swinging back and forth. That 2019 bar is now fixed, or it should be fixed. And now we're looking at 2020 to move.
Yeah, and so as we get closer to the present day situation, it's not as ugly as it was at one point in time. The pendulum is in the swing back to the other side. You know, some of the news about the vaccine, some of the stimulus relief and that type of stuff is taking shape here, but you know, all of that is just part of the quagmire in the middle of the chasm. Can I put two metaphors together?
Sure.
Yeah, but what I want to draw your attention to is the expectations for 2022, 2024, 2021 for that matter, at an all-time high. At least, and I think it is an all-time high. It certainly is. It's a relative high, even looking back 50 years. And those are still the expectations. And if you really look back at all of those graphs previously, those long-term expectations have not changed dramatically. I think they're probably a little optimistic historically when we're looking at this type of information, but they're pretty robust. And so,
well, and we did make the point back in April when we made this presentation, Mark, that one of a thesis that we might pull from some of this data that was coming, and that was when 2020 had turned around and begun to move back towards the blue line. As it turns out, it had further to go the other way before it turned around. But the thesis was that by 2021, we were going to hit that blue line again and go back to trend. And that appears to be what's happening right now. And that's what gives me at least reason for optimism in going into the future, that we have turned around and we've gone back to this steady kind of growth in profitability. And that's important if we're going to have investments that grow at any kind of a rate to keep us even or above inflation.
Absolutely. So let's talk about what it actually does to us. And what you're looking at here is a visual analysis of the major milestone judgments and data arrays for any company. The top is the revenue slide. And we don't even need to talk about what company this is. Here is the period where there was where we're in the current recession. We're actually coming up on this point in time right now as Christmas approaches. And what I want to observe is that these 3 points are basically off the chart. They're off the trend line in a way that's not been experienced at least back to 2010 in the case of this company. So, you know, it's important to keep that long-term trend in mind so long as you have a company that will survive the economic test that it's going through. This particular company had lost 80% of its value in the chasm and dropped from a price of 90 something down to 20-ish. And the graph down here actually shows not the earnings, but the cash flow for the company. And I think we can all notice that a negative cash flow is something that had not happened, at least in this 10-year historical period. So this shows you fairly dramatically how the chasm effect messes up, what you're looking at in terms of studying a company like this. For a beginning investor, probably want to set this one aside because unless you've got enough experience knowing how to reach for sustainability of companies, because it's just an area to be really careful about. Any comments on that, Ken?
No, I think you said it well, Mark.
All right. So what does it do to our studies? Here's what it does to our studies. You're basically talking about a trend line that's somewhere in that 40, in this case, million area, up around the top of this yellow shaded area. And what's actually happening, this is an actual number now as it's coming in towards year end, is that's a huge difference between the long-term trend line for this company and where it's at today. So again, this difference here between the long-term trend line and the actual results for the end of 2020 is pretty massive, extremely massive. Where does it mess us up in our analysis? Well, one of the places that it can really mess us up, and in fact, one of the people attending the meeting today, Cynthia, pointed this out a few months ago, and I got to confess, I was remiss in actually diving in and correcting this for companies. We're going to talk about that here in a few minutes. But if you think through the analysis, and we're basing the future price on understanding what the sales profitability, again, sales being the straw that stirs the drink. Sales is where it all starts. And in this case, the current sales is in no way, shape, or form resembling the trailing 12-month sales anymore. Because the traditional formula for calculating that point out on the far right-hand side, the long-term forecast for sales, is to take the current sales as measured by trailing 12-month sales and escalating it out 5 years at whatever the sales growth forecast, that's the slope of the red line, what it is. And I think you can see that differential inside that yellow circle is messing things up greatly. How's that, Ken? Does that help to understand?
I'm gonna make two comments, Mark. First of all, the comment would be that we've made the observation many times that where you start a race dictates where you finish the race. And if you're going to start the race at a point that is abnormally low, that might be regarded 2 or 3 years from now as what I hate to call an outlier.
I knew that was coming.
But what our methodology calls an outlier that you might even ignore, I think that we have to understand that sometimes we need to start that race at a little bit different point. Maybe it's at the end of a trend line, maybe it's even at the piece of physical data that is before where, higher than where this one is, and we have to be artificial about creating it. But where you start determines where you finish, and we're starting abnormally low on a lot of these companies that still haven't opened, that maybe have another 9 months to a full year runway before they will fully open and fully become profitable again. And so we have to do some real thinking. We can't just apply this wonderful tool that we have, this analytical tool. We can't just apply it blindly and hope that the values are going to make any sense. Mark, I want to answer a question also that used to come up in my classes all the time with students that were beginning to do mathematical modeling and everything. Can you go back about 5 slides or so?
5 slides. Tell me where to stop.
Yeah, please. Keep going. Yeah, that's pretty good.
Okay.
And folks, I want you to all to be clear, and I've tried to write it to a couple of you in text here, but I'm going to try to announce it to the entire audience. We want to be extremely clear that on this particular graph, 2004 through 2018 is historical fixed data. It's not changing at all. And the 2019 data is very near being fixed in June 25th, 2020. because most of the companies have reported their 2019 profitability numbers by this particular point. Now, I know the graphs look different. Go up one more slide now, Mark, towards the, yeah. I know the graphs look different, but that data hasn't changed from 2004 to 2018, even though they look like it might have changed. What's changed is the scale way over on the left-hand side of the graph. When the scale changes, then the bars look higher or look lower, but the values on those bars have not changed at all. So that's what you have to keep in mind. The bars that are changing are definitely 2020 through 2024. And depending on when you're looking at this graph, that 2019 bar may or may not be changing. I'm going to guess that at November 24th, 2020, the 2019 bar is also fixed on this graph, but the 2020 bar is still in play. Now, the next time we graph it, if that scale on the left changes, if 12 isn't the high, but maybe 14's the high, then the shapes of the bars will change, but their values will not. And that's something you have to keep in mind as you're creating a model and as you're doing the mathematics behind what it is you're trying to fit your data to.
Yeah, and just the one tiny clarification, the one thing that would change those red bars going back to 2004 would be when companies disappear through acquisition or bankruptcy or whatever. The mix of companies can change, and there's another fairly rare and actually mathematically insignificant thing that happens, and that's restatement. Restatement of earnings would fix that. Could change it around, but it would take a whole boatload of restatement by a whole bunch of companies to change the essence of that graph. Is that fair?
So we'll put a tiny asterisk down in the corner, but for beginners, those bars are fixed. That's what you have to kind of keep in your head as you read them.
All right. So by now, a bunch of you out there are trying to figure out what company it is. This is United Airlines. And obviously, they are going through a very industry-specific thing right now. A really nasty moment. One of the ways I like, and in fact, I wanted to, on the side, do a little bit of a lottery as to how long it would take Ken to complain about the word outlier. Sign up by the minutes, and I think I would have been pretty much right on. No, but outliers, they can actually cause more problems than the challenges that they solve. But I do think we can look at the information, and it can take all the numbers off of it and just look at the information in that red circled area, and it's kind of like a Where's Waldo moment. Which one of these is not like the others? And I think everybody in the room understands that this one right here is not at all like the others. And that's kind of my definition of an outlier. Does that make your skin crawl, Ken?
Yeah, but that's okay.
Because that looks to me like it's a pretty unusual moment. And it does happen in the life cycle of companies, with or without great depressions and enormous economic recessions, but that looks different to me. So you want to keep that in mind. So in this case, we're talking about United Airlines. Again, I think that the long-term growth rate of United Airlines is something in low single digits. We could have a debate about whether it's 0.5% or 3% or 4%, but it's all pretty much not going to dramatically change the slope of that red dotted line at all. And, for a company this size, that is the best way to look at this and regard 2020 as a moment that just does not add up and is inconsistent with all the rest. And We're actually showing you here a little bit of a secret. This is kind of Hugh McManus's magic sauce revealed, because this is the thought process he's going through in his head. I don't know if he was with us, but he could join in on this if he's actually with us. He said he might join us late. And as we've told you in the last several weeks, he's out there on the front lines figuring out ways to deliver vaccines, so we don't want to get in the way of that. But Hugh is literally taking a look at a company like this, looking at a price situation like that, and assuming this is going to come true up here in some way, shape, or form. That it's going to return to that trend line. If it does return to that trend line and the company doesn't disappear from the planet, it can be a very rewarding situation. So again, the difference between using, in this case, I believe that would be 18 million instead of 40 at this point in the calculation. Now, obviously, you can use the 18 million and grow it from here to here at whatever slope that is. I don't recommend that because that gets terribly confusing. So again, you're stuck with that long-term trend, which I think is the most representative way to look at a company that has chasms embedded. Any other thoughts on that, Ken?
No, I agree with you, Mark, that projecting from the end of a trend line in this particular time period where you have these giant jumps down, and in some cases these giant jumps upward, I think that end of the trend line makes an awful lot of sense. And if the jump down is moving that trend line too far to the down, then knock it out of the data for a couple of months, for 6 months or 8 months, until you get past it and move back to more, and I hesitate to put air quotes around any word, but until you get back to more normal sales, treat that with kid gloves and play with it if you have to, and think your way through the analysis.
Okay, so some of the ways to keep track of a company that's on the ropes. You can see that over this would be a quarter-to-quarter comparison of their long-term debt. This should be fairly intuitive to those of us that are tracking these type of companies. They've taken on some serious debt, going from 14.6 billion back in August to 22.6 in November. The thing that I do want you to notice is that the banks are continuing to give them that at a fairly attractive interest rate. Their effective interest rate actually went down. So that's basically a bunch of major banks telling you or signaling that they are betting that this company is going to survive. If you had a company, perhaps a smaller retailer, that type of company where the number here was 5.8, they took on more debt, and the number over here became 9.8, that's a horse of a whole different color. That tells you a lot about what they think the future might hold for the company. So just a way to dig deeper into the numbers and get a deeper understanding. I do want you to notice that, after this analysis is done, the projected return resembles the projected return on value. I think that's important for it to be to resemble. Doesn't have to match, but resemble, I think, is fairly important. All right, ready to move on, Ken?
Definitely.
All right, so any other Elf fans out there? Kim's got to be an Elf fan.
Absolutely, I have all the movies.
Well, Will Ferrell, this is actually the scene in the movie where he outs the fake Santa Claus and they get into quite the brawl. And that's actually a Lego construct in front of him there that gets demolished for a cleanup on aisle 4. All right, here's our cleanup on aisle 4. And Jay Barry, I think this is what you were talking about, because I think you were trying to copy this down just as quickly as you could. I want to talk a little bit. This is a little bit of inside baseball, but it's not bad. Bear with me here, everybody. What I'm basically showing you is how we look at the database and make some adjustments in situations like this. And like I said, and I have to confess to Cynthia, probably should have done this a few months ago when we first talked about it, Cynthia. But what it comes down to is we're looking for, here's the algorithm. It's pretty simple. Show me the companies in the database that have the lowest earnings per share stability In other words, the lines that are least straight on a stock selection guide, sort of like this one and what you see here, okay, least straight on a stock selection guide, low EPS stability, and then also show me the companies that have the highest difference between the projected return forecast as measured by the par that's in this red square here and the projected return on value, which is this column here, and the difference between the two, and rank them from highest difference to the lowest difference. So I've taken the top 20 candidates for an audit within the manifest database. And what we would basically do, again, notice that all of these have very low single-digit earnings per share stability, is begin looking at each one. And the audit basically is it messed up when it comes to the trailing 12-month sales, just like we showed you for United Airlines? Or could it be that the net margin is what has gone off the rails because of what's been going on with the Chasm? And then, especially for early stage or smaller companies or whatever, does the PE average make sense? And in some cases, it can never make sense. You can have a company that has a PE in triple digits. It's just a company that really doesn't have a PE yet. That's just math. So some of these are override situations, but basically what we're doing is sequencing through this entire list with the attention of, what gets disrupted during the deepest throes of a recession. Do we need to adjust the trailing 12-month sales to reflect that United Airlines situation? Or, has the profitability been disrupted? And again, can we condition the PE so that the projected annual return will, again, not necessarily match, but resemble the projected return on value? Because we know that makes general, in an umbrella fashion, long-term sense to us. Does that make sense, Ken?
In a lot of cases, yes. I noticed one or two companies that I just don't understand why they're on a list like this. The one at the very bottom of the list concerns me. Why does Fluor, an old line, well-established company, show up on a list of all these companies that, for the most part, are kind of new to our senses, new to the market, things like that?
I guess I believe that the growth rate is probably fairly representative. I think that their profitability might be dinged by, if again, intuitively, and again, I'm thinking out loud here with everybody tuned in, so it could be a painful moment for all of us. With the infrastructure projects, and Fluor is also heavily engaged in the oil and gas industry. And the net result of some of the stuff that's been going down in the last 3 to 6 months in the industries that they serve means that 0.5 might really be unusually or artificially depressed by the math that we do. So it would have to take a look at it. One of the other reasons I believe that to be true is that PE is probably a fairly representative or characteristic PE for Fluor. So my number one candidate to really rake over the coals is probably the long-term projected profitability for Fluor. And what I'll do to the session notes on the Manifest Forum is actually take a closer look at Fluor and see where that ends up. So what I'm saying is the adjustment to the profitability expectations for Fluor will probably result in bringing this -8, which I think is probably wrong, more into alignment with this 2-ish number. Then we'll also be comparing to what Morningstar expects and that sort of thing. But that is the type of thought process. It doesn't take long usually to spot where is the problem child in the equation when you start cranking through them. But some of these, just look at the numbers in the red box. some of these are a mess. Sometimes they're a mess for a good reason, but we definitely want to be scratching our heads on them and making sure that they again resemble that projected return on value, which is probably less volatile and a decent number to look at. All right. Any other comments, Ken?
No, we can talk about this graph for the next 45 minutes, but I think we should probably move on.
Yep. So let's go ahead and do that. Again, the payoff, and some of you have seen this before. I think it bears repeating. We've repeated this at a couple of different sessions. It might be new to some of you. I'm taking us back to February 2009, in the teeth of the 2008-2009 horrible recession that we had back then. I think horrible is a better word than Great Recession. How about horrible recession? So back in the teeth of the horrible recession, back in that time frame, notice the companies, a lot of household names. These are the companies that were the consensus selections for the Groundhog Challenge that year. And the projected return forecasts, notice on the far right, some of those are nosebleed, stratospheric. And again, you've heard us tell the stories many times over of Ken and I would call each other on the phone in the morning and say, can this be right? You know, can this study on Cognizant that shows a 24% par and an upside downside ratio of 18 be right? And I know you remember those moments well, Ken.
Well, I just jumped out of the presentation, Mark, and looked at one of my spreadsheets. I bought Microsoft the first time back in this time frame, and I have a basis number on Microsoft of $16.60. So it was awfully close to when you manufactured this slide. There was a company that I just couldn't figure that if I could grab for less than 20 bucks a share, something great was going on. Microsoft is now the largest holding in one of my portfolios. In fact, I'm debating on whether I have to trim it or not. And it's certainly not trading at 1640 after, what, about 11, 12 years now. So,
well, it's the number one.
These charts, yeah, these charts can really help. Yeah.
That's the number one position in the roundtable.
Yep.
Microsoft. So, I mean, this is what it looked like. And again, in many cases, we had to grit our teeth, make sure we were using the trend lines for the beginning of our forecasts, audit the profitability, all that stuff that you would do during a study. And here's the results 10 years later. The companies are roughly in the same order that they were on the preceding slide, only in this case, these are actual returns. And Ken, I think that means you're buying dinner next time we're together.
Well, you have to open up your books to me first, Mark, you know, then we'll see.
Well, again, the payoff is there's really a tremendous, and you don't have to invest in some of the weird companies that Kim and Hugh invest in all the time to achieve these numbers. There's some pretty household names on that list also. I endorse, by the way, Kim and Hugh's activities, but you don't have to.
Say, some of those odd names have been very profitable. But I will still have Ken take us out to dinner because I think his multi-bagger is more than mine or yours.
Yeah, there we go. So we can celebrate that.
I'm going to answer one question real quick. Buffalo Wild Wings, folks, was purchased. That's why there's no number next to annualized total return there. Yeah, it was purchased sometime between the 2008 period and today, and it's no longer a single public company that you can buy.
Yeah, it was actually acquired by Arby's, and if I would have been willing to bet a steak dinner that Arby's would not be the company to acquire Buffalo Wild Wings, and I would have lost. All right. Let's go ahead and wrap up for the day. Hopefully that gave you guys something to scratch your heads over and contemplate. And as you know, for the last several weeks, we've been sharing some of our favorite books. The ones that we have talked about here over the last month or so are shown. And last week we shared Dear Shareholder by Lawrence Cunningham and Jim Clunan's Investing at Level 3. So those will be thrown into the library. And this week we're going to add a couple more. I tend to be a very traditionalist. And if it's The Intelligent Investor or Peter Lynch or even The Motley Fools or something by Warren Buffett, that tends to capture my attention. And I'm just really grateful that Kim is here to nudge us into some other areas that can be very rewarding. Here's one of them. Go ahead and talk about this one, Kim.
Okay. As many of you may know, you may or may not recognize the name Peter Thiel. Well, he is the guy who started with PayPal, and he helped start PayPal with, when it was underneath eBay, and ultimately, there was a group of guys. They call themselves the Brain Trust. Write this down if you get a chance. It's called the Founders Fund, F-U-N-D. Look that up on Google. These guys are like, let's say there's 8 of them together, the Brain Trust. They are the smart guys who are forward thinkers, disruptive technology that Ken talks about all the time. And that's how we got PayPal. That's how we've gotten some of the Instacarts, the Airbnb. Currently, Affirm is another one that's underneath the Founders Fund that they have started off with by Max. I can't pronounce Max's last name. But basically, this book is fascinating because we as investors see something that is a new IPO or a spinoff, and we go, okay, here we go. Now let's look at these numbers. No, and we were taught in the Better Investing that you don't look at it until you got 5 years of history. Well, some of these have got 5 years of history, but they've been private. And what do these insiders, how do they make their governance? How do they make, and the big thing I've learned is follow the money, and what are the insiders doing, and what is the executive compensation package, because that finds out for you what their motivation is to make sure that the company will be successful. Even talked about how some companies may not be successful because you've got personalities that just won't mix. So I read this book. I thought it was absolutely fascinating. I think it's another one that I'll have to go back and reread many times, because now we're getting stocks that are coming to market, not on IPOs, but just coming to market on their own. And how do you look at them, evaluate them, figure out what you should do on whether or not you want to be a part of it or not. So
very cool.
Yeah.
Well, Peter Thiel was also one of the pre-IPO, private venture investors in Facebook.
Yeah.
In Facebook, and a few other companies. Ken, I'm curious. Since Natalie is our resident disruptive analyst, does she have any awareness of this book?
This one is not on the bookshelf. The one that we're both reading again right now is called Factfulness by Hans Rosling.
That's a great book.
And if it's not specifically an investing book, but it's a way of re-examining your thoughts about a lot of things, and seeing value in places where you maybe didn't see value before, and challenging some wisdom that is supposed to be common knowledge, and maybe it's not so common as people want to think it is, and maybe it's not based on any knowledge that a lot of people have. But it's an absolutely fascinating book. I wish he were a slightly better writer. He kind of gets himself buried a number of times in paragraphs. But Hans Rosling, Rosling, and the book is a single word, Factfulness.
Yeah, I'll add that to the list also. And there are some fairly, he's not a whole lot better on the YouTube seminars either.
No, he's not.
But it is, it is a challenging thing, and I'm not going to go on this soapbox, but given the current state of our journalist community, and that's all I'm going to say. You can decide which way you think I'm leaning on that topic. It's a fascinating read when you start thinking about what if what you're being told is not necessarily based in a whole lot of fact. Good.
I would urge you to read Rosling before you go to YouTube and try to listen to him.
Okay. All right. Like I said, I tend to lean on some of the more traditional stuff, although I have the deepest respect for what Kim and Hugh do and Natalie Kavula. In terms of the disruptive stuff, this is a book by David L. Babson and his brother. The title is Investing for a Successful Future, and the real link here is it was the subject of the first book review in Better Investing magazine back in 1960. You can actually dig back and find that review. More importantly, Babson basically championed arm in arm with T. Rowe Price and a couple other people the beginning of growth investing, and really nurtured and promoted a lot of the thinking of people like George Nicholson, the founder of the Modern Investment Club movement, and many of the people back in the 30s, 40s, 50s. A lot of times Tom O'Hara would remind us to think about the environment, coming out of the Great Depression, again, horrible depression, and how stocks were seen as something for gamblers, that sort of thing. And what Babson did is pointed out growth companies like 3M, Polaroid, that's an interesting entry, Abbott Labs, Lilly, and other companies like that, and showed how you could invest in, at that time, those were very dynamic, they're now mature, but very dynamic growth companies, and really championed some of the style and investing technique of the Modern Investment Club movement. And again, featured, he was recognized many times by Better Investing as one of the long-term champions and formative forces in investing. So I recommend the book. It is actually still available online, and I've got a signed copy on my bookshelf, so I'm kind of partial to it. All right, just as a reminder, we do archive all of these presentations. We archived all of the Successful Investing Conference from a few weeks ago. On the YouTube page, just go to youtube.com, search for Manifest Investing. You'll land at this page. You can subscribe if you like what you see, and you'll get reminders anytime we post things. But we do post the roundtables and the bull sessions right here. I also wanted to remind you that they are the recent Successful Investing Conference is available as a playlist, all 5 of them grouped together. And with that, we're going to close with Will Ferrell. For those of us that are hopelessly addicted to that movie, it's a good scene. So with that, Ken, I think we can go ahead and sign off. We'll be back in about a week. And let's thanks everybody.
Thanks
and we'll hang around for some questions.
Thanks to everybody, and good night all, or good afternoon all.
All right.